Hi, it's Sober Harrison. I'm about to edit the video and I was reviewing the footage and I apologize for what you're about to witness. It is a mess in terms of my organization of what I wanted to talk about and the audio. You'll hear a lot of background noise because my roommates like to watch movies at night. So there's just a lot of movie dialogue in the background, and that's actually why I'm in my closet filming this intro, because they're watching another movie. But I'm still going to edit and put this video out anyway, because perfect is the enemy of progress, and I am on a quest to quit my job so I can do YouTube full-time. I'm kidding, by the way. If my job watches this, I really love working at my job. I love the paycheck, I love the people, I love the culture. Please don't fire me, thank you. Hi, hello, my name is Harrison. Welcome to the Casual Commons, where we're just common people being casual with our oversized polos and Texas caps. Today, or right now, it is a Saturday night, and I have some juice. So you know what that means. It is another drunk finance Saturday night. We talking about finance tonight. So what I really want to talk about is why it's so hard to start investing. And this was prompted by me just browsing Reddit, me just browsing other forums I'm on, and a common complaint was that people just have a hard time really getting into investing, or when they first started investing, they found it really hard and it took a while for them to really get into the flow of things. And when I talk to my friends, they're also like,
I don't know what to do. Like, I just make my money and I put it in the savings account, and I just don't know how to invest because, you know, I just don't know. Like, I was never taught it. I never took a finance class on it. All I did was intro to finance, where I learned net present value, and that's it. I never learned how to invest for my people.
So that's what we're going to talk about today. Cheers, by the way. And before we really get into it, I am not a accredited, certified financial planner, advisor, nothing. This is not financial advice. You should not be listening to a stranger downing a claw on the juice on the internet. But if my friends came and asked me, Harrison, can you help me get started in investing? Like, what would you recommend? This is what I would tell them. By the way, just want to say that there are a lot of reasons why people can't start investing, because they have to take care of other responsibilities before they even have money left over. And like, sometimes people don't have money left over to even invest, or they have to spend it on like other repairs or maintenance in life. And this video really isn't looking at that. It's more towards looking at people who have saved money and like really want to put it to good use and to get into investing. And obviously, like, if you've made it this far, I think you're doing a lot better than most Americans, because people will just be in debt sometimes, most of the time for really good reasons. I don't think anyone wants to be in debt for silly reasons, but there are people being silly. But this video is just to address people that really want to get started in investing but just don't know how. So we're going to talk about kind of the pitfalls or roadblocks, or why it's so hard to get started investing, and like how those roadblocks can be overcome. So the first point why I think people find it hard to start investing is it seems inaccessible, right? If your employer doesn't offer you like an automatic 401k investing account, like how do you even go about opening an investment account? I feel like when people think about doing that, they think about middle-aged people in like suits going to the banks and talking to a fund manager to open their accounts. But in reality, I think with the internet and like with mobile platforms now, there are plenty of ways that you can start an investment account like straight from your phone the same day without talking to anyone, without having to like even call anyone. All you really need is just, you know, your information, your social security, so that they can like track down your taxes that you need to fill out, and then you're good and you can start investing. Although with that though, I do want to say that even with like Robinhood and like all these good investment companies that like you can sign up with, I highly recommend to my friends that they should look at tax advantaged accounts, specifically accounts geared towards retiring. So if that's not a 401k that your employer offers, or if they don't offer it, that could be a Roth IRA or individual retirement account. And the reason why I recommend that first is because there's an incentive in America to have people save up for their retirement. And so with these accounts, you would pay less in taxes, or when you sell your stocks, like pull out money, it's taxed differently than income. So it's like a little bit less. So I would start there rather than starting in like a regular investment account, just so you can get the tax benefits. But again, that's besides the point, because the whole point is like you really can just open an investment account or an IRA literally on your phone. If you just download the app, sign up, you're good. You're good to go. For IRA accounts, you usually have to go through like old school players, and that'd be like Morgan Stanley, Charles Schwab, Fidelity, Vanguard. They're usually pretty much all the same, and they'll let you trade the same way. It's just whatever you prefer, whatever, the UI looks good, whoever's like customer service you like better, just pick that and go with it. So the second point I have is that people are just ignorant, as in not that it's their fault or anything, but they just haven't taken classes or just weren't taught this. It's not in the American curriculum to teach you about finance or investing. Like for me, I only learned about the methodology or like the basics of finance and investing because I was in business school for my undergraduate degree, and I opted to take more finance classes than I needed to for my major. And that's really where I learned kind of my investment methodology and philosophy. So, and that's okay that like not everyone's taught finance, because there are a lot of good resources on the internet. You can, search up another YouTube video and learn where you should start investing, or like read articles on like how you invest as a beginner. But the only thing I'll caveat that with is that high risk leads to high returns, and the backwards of that is true. High returns lead to high risk, as in if things sound too good to be true, they likely are. So I think what I'm saying from that is just whenever you find these good resources and try to learn from them, I think you should always be skeptical, especially with this video. Like, again, I'm downing a claw and talking about personal finance. Like, it's not professional, but here we are. So my third and I think most important reason why I think it's so hard to invest is because there's so many options. I personally feel like I have a good grasp on investing and like where I want to put my money, and I like have a really good plan. But every time I do have money left over that I, want to put away to invest for my future, even I'm like faced with kind of this issue with like too many options. Like it's called decision fatigue. So like even when you have your brokerage accounts, you have your investment accounts, you have money to, start investing, and you even learn the basics. I'm not even talking about like calls, puts, options, trading. No. Even when you're like ready to just put away money for your retirement, it's hard because there are so many funds that are recommended. There are so many index funds that people will tell you to go to. Do you want to put money into a technology? Do you want to put money into oil and gas? Do you want to put money into Apple? Do you want to put money into Tesla? There's just way too many. There's an infinite amount of like combinations you could do to invest. So this happens because there's a psychological effect, or I guess concept, called decision fatigue over choice, or the paradox of choice, meaning that when people are given a lot of choices, they are less likely to pick one in a shorter amount of time. So think about like going to the grocery store and you need to buy like sugar, and you see 15 different brands of sugar. You're looking through them, you just don't know which one you should buy. Should I buy the cheap one? Should I buy the more expensive and healthy one? Should I buy this one that claims to be eco-friendly? And you're like sitting there and just looking for like a good 5 minutes when you could have just picked one in like 5 seconds and then on your way. Think of that in kind of a larger scale when people invest. So when people are trying to put money towards like a stock or like an index fund or like, I don't know, like some fund, they sit there and they don't invest, and they're like, maybe I'll do some research over the weekend and then I'll invest later. There's just too much you have to like look into. You can't just like research the whole market. So what ends up happening is a lot of people just put it off and they just keep their money uninvested so it can't grow. And I think that's a real detriment, because there's a famous saying that says time in the market is better than timing the market, meaning that the longer you have your money put in the market and the more consistent that you put it in, the better off you will be. I think there's like plenty of studies done where they track 3 different like people, and these are like made up characters. One only invests when the market goes down and like times it perfectly. The other one only invests when the market is at its peak and like sucks at investing. And there's one who invests money like consistently regardless of when the market is up or down. And it turns out that the person who invests consistently, even if they can't time the market correctly, ends up having like a better portfolio and more money accrued from it because they let that money grow slowly, and over time it collects compound interest and that just skyrockets. And so money that you invest consistently and that stays invested is better than money that you pull out or just don't invest in that sits waiting to be invested. So to overcome that decision fatigue, I think there's like really one important thing you have to learn about yourself, and that is your risk tolerance, meaning 2 things. One is how much risk can you take on, as in, or you can stomach, as in like if things go like up and down and like swings like this, will you be able to stomach it? Will you be able to leave your money in without taking out, without panic selling and just keeping it there? Or at least until you think it's a good time to sell it and you make a profit off of it. The other thing is like, how long do you have before you need the money? As in, if you're like someone who is, at retirement age and you need the money to start living on ASAP, it really isn't recommended that you have a lot of money in the market because they swing like this. If you need to withdraw your money when the market is down, you end up losing money. You have to take the loss so you can pay your bills as an old person. If you are young and you have 40 years to invest and work, then you can afford to keep your money in the market. When it goes down, you don't have to take it out because you're still working, you still have a job, you're still making money other ways. When it goes up, you don't care either because you still don't need to take the money out. So I think those are like 2 things you have to think about before you start picking what you want to invest in. Since my friends are my age, which is 24, 25, 26, mid-20s, I always recommend that they go for index funds that track the market, meaning that there's a company that buys all the stocks in the market, and well, they buy like how it's weighted. So like if it's a giant company like Apple, they'll buy like a good chunk of Apple. If it's like a small company, like a small company that's being traded, they'll buy like a tiny little fraction. And then what they do is all of their stocks that they buy, they break it into like other stocks that you can buy from. So instead of holding just Apple or just Facebook or just Microsoft or just Tesla, you're holding one stock that is 13% Apple, 1% some company, 2% like Facebook or whatever, or however they decide to like track it and weight it. So in the case that Facebook goes down, Apple goes down, or like the small company goes down, you don't lose everything because all the other companies you own are still good. And what happens is that big company that you bought from will reweigh things. So like if things fall in and out of the market, they'll sell it off or buy some. So essentially you just kind of own the whole market, but at a smaller fraction. That sounds a bit too good to be true, but it really isn't. So it does come at a cost, like, right? Because if you were to buy all these stocks, they would be expensive on your own. So you're relying on this company. So it's like, what's in it for them? Well, they charge something called like an expense ratio, where they'll skim some like money off of like what you earn on it through dividends, or like when you sell, or like when you buy into them. But usually if it's a reputable index fund, they'll charge like 0.02%, meaning that like if you have $10 invested, each year, each period, or however they structure it, they take off 2 pennies. So you don't get the full return, but it's so minimal that it's worth it. Like you don't have to be the one to reweigh things. You don't have to be the one to buy and sell things. All you do is just buy shares from that and you're good.
But Harrison, you just said that if you invest your money into one company and it goes out of business, then you're shit out of luck because you'll lose all that money. So what's the difference in investing in a fund where you also, it's just one company and you risk it going out of business?
Okay, fair, true, but these funds are insured. So like even if they go out of business, which is highly unlikely because their business depends on all companies' businesses. So it's really unlikely that all companies will collapse. If they do, we have bigger problems on our hands. It is a collapse of civilization. So at the end of the day, your risk is all companies going out of business before you start losing money. So take that as you will. Again, this is not finance advice. This is Harrison's advice for his friends in real life, not people on the internet. So please don't sue him. So that is all I really wanted to say on why it's hard to invest. If you got one thing out of this video, it really should be the best time to invest was like yesterday, but today's okay too. So really put your money away for your future self, and you'll thank yourself when you're 65 and you don't want to work or can't work, and you have money that your 25-year-old self put away. Thank you for watching. Subscribe for more. This is not a finance channel, but when I get a little tipsy, it's fun to talk about finance. Bye.